$40 billion. That is how much wealth was wiped from the global crypto market in a single week in May 2022. Not from a hack, not from a regulatory crackdown, not from a market-wide crash. From one algorithmic stablecoin and its sister token collapsing like a house of cards in a rainstorm. The Terra Luna ecosystem did not just fail. It detonated, and it took thousands of ordinary investors down with it. Welcome to BlockVault Daily. Today we are going in deep on one of the most dramatic collapses in the history of decentralized finance. The rise and fall of Terra Luna is not just a cautionary tale about crypto risk. It is a story about ambition, design flaws hidden in plain sight, and a community that believed so completely in a vision that they ignored every warning sign along the way. And here is the part that will stay with you: the very mechanism designed to make Terra stable is exactly what made it catastrophically unstable. We will explain exactly how that worked and why regulators around the world are still reacting to it today. To understand what went wrong, you need to understand what Terra Luna was actually trying to be. The project was founded in 2018 by Do Kwon and Daniel Shin through a company called Terraform Labs, based in South Korea. The core ambition was enormous. They wanted to build a decentralized payment network with its own stablecoin that could rival traditional financial systems. The stablecoin was called UST, which stood for Terra USD. It was designed to always be worth exactly $1. The companion token was Luna, and together these two assets had a relationship that was mathematically elegant and, as the world would discover, dangerously fragile. Here is how the mechanism worked. UST was an algorithmic stablecoin, meaning it was not backed by actual dollars in a bank account the way USDC or USDT are. Instead, its peg to the dollar was maintained through a mint and burn system involving Luna. If UST traded above $1, users were incentivized to burn Luna and mint new UST, increasing supply and bringing the price back down. If UST traded below $1, users could burn UST and mint Luna, reducing supply and theoretically pushing the price back up. The system relied entirely on market participants behaving rationally and on there always being enough demand and confidence to keep the loop functioning. That is a lot to ask of any market, especially a volatile one. But here is what nobody talks about enough. This system had been stress tested in relatively calm market conditions. What nobody had fully modeled was what would happen if confidence in UST dropped sharply and rapidly at the same time that broader crypto markets were selling off. In that scenario, both legs of the system could fail simultaneously, and that is almost exactly what happened. By early 2022, Terra had grown into one of the largest blockchain ecosystems in crypto. Luna hit an all-time high of around $119 in April 2022. The Terra ecosystem had over $18 billion in total value locked across its DeFi applications. A major driver of this growth was a protocol called Anchor, which was offering depositors a nearly 20% annual yield on UST deposits. That number attracted billions of dollars in capital, and it also raised serious questions about sustainability from analysts who understood what was funding it. The yield was not being generated organically. It was being subsidized from reserves, and those reserves were finite. The Luna Foundation Guard, a nonprofit set up to support the ecosystem, accumulated over $3.5 billion in Bitcoin as a reserve to help defend the UST peg in case of a crisis. Do Kwon was publicly confident, dismissive of critics, and intensely present on social media. The community around Terra was passionate and deeply invested, both financially and emotionally. The project had real-world adoption in South Korea and was expanding into payments, e-commerce, and international remittances. On the surface, everything looked like momentum. Under the surface, the architecture was one crisis of confidence away from total collapse. That crisis arrived in the second week of May 2022. On May 7, a large amount of UST, estimated at around $85 million worth, was withdrawn from Anchor and quickly sold on liquidity pools. This created initial downward pressure on the UST peg. The exact identity of who initiated this is still debated, with some analysts pointing to a coordinated attack by a large entity or fund. Regardless of origin, the effect was immediate. UST began to slip below $1. As confidence wobbled, more holders began selling their UST, further weakening the peg. The algorithmic stabilization mechanism kicked in, minting enormous amounts of Luna to absorb the excess UST supply. But this flood of new Luna into the market caused Luna's price to crater. And here is the death spiral dynamic. As Luna's price fell, the newly minted Luna was worth less and less, which meant you needed to mint even more of it to maintain any semblance of stability. The supply of Luna exploded from roughly 350 million tokens to over 6.5 trillion in a matter of days. That is not a typo. 6.5 trillion tokens. The hyperinflation of Luna made it nearly worthless, which in turn gave the market no confidence in the UST mechanism, accelerating the sell-off on both sides. The Luna Foundation Guard deployed its Bitcoin reserves in an attempt to defend the peg by buying UST off the market, but it was not enough. Over $3 billion in Bitcoin was spent and the peg never recovered. By May 13, Luna had gone from over $80 to fractions of a cent. UST was trading around 10 to 20 cents instead of its intended dollar. The total market cap of the Terra ecosystem had gone from roughly $60 billion to nearly zero in about 72 hours of active collapse. The human cost was severe. Retail investors in South Korea, the United States, Southeast Asia, and across Europe had poured life savings into Anchor protocol chasing that 20% yield. Online communities were flooded with accounts of devastating losses. Regulatory bodies worldwide issued statements almost immediately. South Korean authorities launched investigations into Terraform Labs. Do Kwon, who had been publicly vocal and combative throughout the collapse, eventually faced an international arrest warrant issued in September 2022. He was arrested in Montenegro in March 2023 and has since faced extradition proceedings to both South Korea and the United States on charges including fraud and market manipulation. So what are the real lessons here, and why do they matter far beyond Terra and Luna specifically? The first is that algorithmic stability is not the same as genuine stability. A mechanism that works mathematically in normal conditions can fail catastrophically under stress if it relies on continuous market confidence. The second lesson is about yield. When something offers dramatically higher returns than anything comparable, the question is never whether it sounds good. The question is always who is paying for it and what happens when they stop. Anchor's 20% yield was a growth strategy funded by reserves, not a sustainable yield from real economic activity. The third lesson is about community dynamics and narrative capture. Terra had one of the most passionate communities in crypto. That passion was a real strength during growth, but it also made it harder for individual investors to critically evaluate the risks they were taking. When credible analysts raised concerns about UST's mechanism or Anchor's sustainability, they were often dismissed or attacked online. The social consensus inside the ecosystem had become disconnected from the structural reality underneath it. The collapse of Terra Luna directly contributed to a broader crypto market downturn through the summer of 2022. It accelerated the failures of several crypto hedge funds and lending platforms that had significant exposure to Luna and UST. It became a central reference point in regulatory discussions about stablecoins in the US Congress, the European Union, and Asia. The event fundamentally changed how policymakers think about algorithmic stablecoins, and several jurisdictions are now explicitly restricting or scrutinizing them as a category. Terra did attempt a relaunch. A new chain called Terra 2.0 was created, with the original chain rebranded as Terra Classic. The relaunch has not recaptured anything close to the original ecosystem scale or adoption. Before you go, if you learned something valuable today, hit that like button right now. Subscribe to Block Vault Daily for a brand new video every single day. We will see you in the next one.